One.
Well, good morning, good afternoon, good evening, as the case might be. Welcome or welcome back, again, as the case might be. My name is Dalibor Petrovic. I'm a partner at Deloitte, and I have a pleasure of hosting this series of live webcasts that we have been bringing to our Canadian tech leadership audiences for the last 3+ years. For those of you returning, you would know that we are using this channel to bring to you conversations with technology leaders who are shaping the future of Canada. And we had a number of senior chief technology officers, CIOs, and so forth. But we are also using this channel to bring forward conversations that we think are both timely and relevant, both in terms of thought leadership, but also general Canadian technology topics. And today we have one of those conversations ready for you. Today we are going to be unpacking the Canadian technology startup ecosystem, and who better to share with us her perspectives on this topic than Janet Bannister, who is the founder and managing partner of Staircase Ventures and is a legend of Canada's tech startup ecosystem. Janet, thank you so very much for finding the time to be with us this morning.
Well, thank you very much for inviting me, and it really is a pleasure to be here.
Wonderful. So Janet, we're gonna start in a minute or so. Just wanted to remind our audiences that this actually is a live conversation, so please excuse any tech glitches that might occur over the next 50 or so minutes. But also because this is live, it'll give you an opportunity to engage with us directly. So if you have a question or a comment as we go along, please use the QA feature of the Zoom platform and submit a question, and we'll do our best to address as many questions as we can. So, Janet, typically I do not do the introductions of my guests because I always would do a disservice. You have such a phenomenal a career and such a rich profile. I would actually ask you to tell us your story a little bit, how you navigated your career and your life, and where you're at now and what you're doing now.
Yeah, absolutely. Happy to start with that. So I guess I will just preface it. When I think about my career overall and the decisions that I've made, I think a couple of themes sort of come to mind. One is I think I've been very deliberate about my career and what I want to do. And the second thing is I've been willing to take a bet on myself. So with that, I'll just sort of start. I actually had my very first entry into the business world when I was 15 years old. I lived in Toronto near Yonge and Lawrence, and started a muffin business. And I would get up at 1 o'clock in the morning, bake 15 to 20 dozen muffins, and then had about a dozen stores along Yonge Street that I would deliver my muffins to in the morning on my bicycle, and they sold my muffins. So that was sort of my first foray into the business world. And then, after that, then I went to Western, did the Ivy Business School. After that, joined Procter & Gamble, worked as a brand manager there, then worked at McKinsey as a management consultant. And then I decided that I wanted to move out to Silicon Valley and join a fast-growing tech company. I thought that would be a great learning opportunity for me. And it was something that I was interested in doing. So again, sort of an interesting story is that's what I decided I wanted to do, but I didn't know anybody in Silicon Valley. I had no US work visa. And, on paper, I did not look like I was the right person to join a fast-growing tech company, right? I never worked for a tech company. I had no technical background, but I thought, well, no, this is what I want to do. And so what I did was I decided the most efficient way to find a great tech company that might want to hire me was to talk to some venture capital folks, because they would have a whole portfolio of companies. And so to cut a long story short, through persistence and cold calling, I got a meeting with Bob Cagle, who was a partner at Benchmark, who had put the original money to eBay. He introduced me to Meg Whitman, and I moved out to Silicon Valley in early 2000 and joined eBay. At that point, eBay was about, let me just say 80 to 90% of the things bought and sold on eBay were collectibles. So things like coins and stamps. And I was given responsibility for the non-collectibles categories. So things such as home and garden, jewelry, books, accessories, and basically helped to triple or quadruple that business every year, year over year for 4 years.
Wow.
It's a great experience. I then wanted to move back to Canada, so moved back to Canada with eBay. I then launched Kijiji in Canada and grew that to be one of the most visited sites. That was really on the inside of, hey, Canadians spend a ton of time online, research online, but are reluctant to transact online relative to the rates that we see in other countries. And so hence launched Kijiji, grew that business, fantastic experience. Then I went on and did a couple of other things. I was CEO of a venture-backed company. And then 9 years ago, I got into venture capital. So I joined a venture capital firm called Real Ventures, which invests in, at the time, it was one of the largest early stage venture capital firms in Canada. Joined them, spent 8 years there, including the last 2 years as managing partner, and then decided to launch my own fund. And so we had a first close of, so the fund's name Staircase Ventures. We had a first close in March, final close in August, and we exceeded our target fund size.
Wow. What an amazing story. So first of all, congratulations, and congratulations on starting up your own fund. We'll have a little bit of a chat, of course, about what that actually means and how your particular fund is different. But of course, our audience represents a variety of Canadian technology leaders from coast to coast, different industries. And I'm not going to assume that our audience actually knows the details of venture capital business, or even appreciates perhaps the complexities and the history of our Canadian tech ecosystems and early sort of startups. I'd love maybe we start there, Janet. Can you give us a little bit of a context, history, and maybe a current state of the land as it relates to Canadian tech startup ecosystem?
Absolutely. So, I mean, I'll actually sort of start in terms of where it is now, and then sort of some historical perspective. So, if you look at short term and you read in the news, you know, definitely the tech ecosystem, both, you know, with the exception of generative AI, with that exception, the tech ecosystem has been hard hit. And, you know, I think we, as has been well reported, tech ecosystem throughout the world felt the effect of higher interest rates, slower economic growth, you know, the valuations coming down significantly from what I think are arguably unrealistic high levels of valuations in 2021. So that all really over, you know, certainly second half of 2022 up to now is really depressed funding in the sector as a whole and driven down valuations. However, if you just say, okay, that's happening, and as I said, generative AI now is getting a lot of attention and a lot of funding. But if you just say, okay, yeah, we understand we have a bit of a soft time right now, and you sort of zoom out and look historically, what you see is the long-term growth in Canada's tech sector is extremely strong. And in fact, to put Canada's numbers in perspective, if you look at the dollars invested in Canadian, the venture capital dollars invested in Canadian-based companies in Q2 of this year, it's actually the highest Q2 of any year except 2021. And when we look at what we're projecting 2023 to be, 2023, again, this is venture capital dollars invested in Canadian-based companies, 2023 will be higher than any year prior to 2021. So yes, while that it has come down, we've seen it come down. Actually, the Canadian venture funding has come down less than the US market, but it has come down from the highs of 2021 and early 2022. You know, taken historically, we have a very, you know, a growing venture capital ecosystem, a growing tech ecosystem in Canada. And then I think the next question, well, why is that happening? And actually, before I go there, I'll just say, you know, for perspective, when I went to Silicon Valley in the year 2000, I mean, I was struck by how everybody talked about joining a startup or starting their own company. If somebody was leaving eBay, the first question was, well, are you going to start a company or are you joining a startup, right? Which was just so very different from the atmosphere that I'd grown up in Toronto. And I think, Toronto and all of Canada has significantly changed in that, as I said, in that respect. And I mean, I can give you some more stats if you'd like, but the bottom line is in terms of, hey, why is it that Canada's tech ecosystem has grown so much over the past 20 years? And I would point to a couple of factors. First of all, a very strong talent, particularly tech talent.
Yep.
And that comes from both homegrown talent, i.e. coming from our universities, such as University of Waterloo, University of Toronto, University of Montreal, University of Alberta. Those universities are, recognized globally for their AI talent, for instance. So we have that what I would call homegrown talent, as well as immigrant talent. In Canada, last year, there were more STEM immigrants came into Canada than came into US.
Wow.
Think about that. That is incredible, right?
Whoa.
So the immigrant, we're seeing a lot of strong immigrant talent coming into Canada. Then secondly, what you have in Canada is the ability, it's an open market. So Canadian startups are selling into the US almost or virtually from day one. Yesterday, I met with a Canadian-based company that said, hey, all our customers are in the US. So companies are able to locate in Canada, but sell very easily into the US. We are seeing an entrepreneurial ecosystems. They tend to have a flywheel effect where success begets success, where successful startup tech companies, they create talent that knows how to build a tech company. And so, that is a positive network or a positive flywheel effect. And we're seeing that take place. And then the other thing I would say is there's more and more capital US venture capital is coming into Canada. This is seen through the data. I can tell you, typically, I am talking to several US VCs every single week, even in these downtimes, who are saying, we want to do more investing in Canada. We love the quality of the companies. We love the quality of the talent. And we want to do more investing in Canada. I was down in San Francisco last week and meeting with several later stage VCs. And they were saying that, Janet, we want to do more in Canada. Send us your best companies because we want to be investing in those growth stage companies.
Hmm. So what I heard you say is that the market is softer than it was in the last maybe 2 years, but historically the market is actually very strong. And if we look at what was happening before 2021, 2023 will be stronger than any year prior. So yes, it's softness, but I feel confidence in what you are saying.
Yeah, exactly. We're going through a cycle. The entire world is going through a cycle, right? But if you look at the long-term trend, where we're going in terms of, we take it 10 or 20 years, it's a very positive story.
Mm-hmm. Mm-hmm. And you mentioned a couple of positive things about Canadian startup ecosystem and early startup ecosystem, that we have the talent that is world-class, homegrown and imported, right? Talent.
Yeah.
Open market, open to sell within Canada, of course, and internationally. Entrepreneurial ecosystem that kind of teaches others how to rinse, repeat, and succeed, and availability of capital coming from the US, who continue to show interest into Canada. So those four I sort of gathered as the positives. I'd love to ask you to reflect on what are the challenges that Canadian entrepreneurs who are starting tech companies are facing, Janet?
Yeah. So there are some challenges, right? There's always challenges. I think one of the biggest challenges that I see for Canadian companies is, I mentioned, about all the tech talent that's here. That's great. There is not a lot of talent in Canada at the senior leadership level that have grown companies from, say, 50 million to 200 or 300 million in annual revenues. And that stage is where we are missing talent. And I think as a result, we're often, not all the time, but often, Canadian companies are selling out too early because they do not feel, the leadership does not feel that, hey, we can take this to the next level. That being said, so what we're seeing in a lot of cases is that Canadian companies that choose to stay in Canada and continue to grow is they are hiring those senior leaders from the US. And so then what I think about is, okay, if you're hiring those, let's say your head of sales or your head of marketing or your CFO, if these people are being for these fast growing tech companies, as they get above a certain level, if they're hiring those folks in the US, well, then where's the next level of management? Because if that next level of management is not located in Canada, then how are we creating the next level of senior executives?
Yeah. So that would be one big challenge.
Yes.
Right. So, and what I hear you say is that, so typical, so the risk is that if we have to go outside of Canada for that talent, the talent that goes behind that, if it stays external, then we are missing the opportunity to build.
Yeah. And I would also add to it, to hire those people, it can sometimes be more difficult. Because a lot of times those folks, let's just say, for instance, I'll make something up. Your company is at $50 million in revenue. They're on the path. They're growing very quickly. They want to hire a CFO that's going to enable them to continue growing, say, at 75 to 100% year over year. They want to hire a CFO. Now, then they look around and they say, well, we want somebody who's an experienced CFO, who has experience in this industry, and has also taken a company through that process before. As I said, there's not a lot, there are some, but not a lot of people in Canada who have done that. So then the company may say, hey, let's look to Silicon Valley, and we'll want to find somebody in Silicon Valley, as an example, or New York or another ecosystem around the world. Now, they may or may not want to work for a Canadian company, only because they may say, well, you know what, I've got 3 different offers, and I could work for a company that's down the street from me where their entire management is there, and I can actually meet them in person much more. And now you're giving me an offer to join a Canadian company in Toronto. If the rest of the leadership is in Toronto, how often am I going to be on a plane? Yeah, and there's just some people will go, but it can be a more difficult value proposition. It doesn't need to be. Yeah. There are examples of Canadian companies that have overcome it. But again, I would say, hey, it's a challenge. It's not a barrier, but it's a challenge.
Yeah. Certainly. So thank you for that. That actually is very, very good, because what intuitively I know is that, well, one of the biggest challenges in general for Canadian entrepreneurs is to actually scale up and scale out. And it seems to me that, you know, our companies reach certain stage and, you know, they get sold, or they move, right? What you just described actually was a gap that I wasn't aware of. So this is really, really good that you called out, you know, that as a potential issue. For our listeners who are not familiar with venture capital system, and can you describe to us essentially the role that venture capital firms like yours have in helping entrepreneurs succeed? Maybe give us a 101 on how this all works, and then we'll peek into appropriate zoom-ins afterwards.
Yeah. So at a high level, venture capital goes in and invests in tech companies in order to enable them to continue to grow. And the role that venture capital plays is it's companies raise venture capital money because they typically can't get, or I should say, in most cases, when a company raises venture capital money, they cannot get bank financing. And the reason is because the value, this company is being created, it's got engineers, salespeople, except product folks who are building this technology product. And it's not a hard asset like products or like a manufacturing equipment or real estate that a bank knows how to say, okay, I can lend against that, right? And so, because the funding really goes to further develop the technology. Yeah. And so hence frankly, it's a higher risk because there are no underlying assets. Hence the role of venture capital comes in. And the way venture capital works is it goes in and invests, however much money. It can start as low as, frankly, some venture capital firms start as low as $100,000 or $200,000 investments, all the way up to hundreds of millions of dollars, right? Depending. But they invest the money, and in exchange for that, they get equity in the company. And then the role of a venture capital executive is not your partner at a firm, is not just to invest the money, but then to help that company grow. So they typically sit on the board of directors, and their role is to act as a board, the fiduciary responsibility as a board member, and to work with that founder to help them grow.
Yeah. And I also wanted to sort of zoom into the founders themselves. And I know that specifically Staircase Ventures has a unique angle to the founders and support you provide to founders. So maybe you can reflect a little bit on that, and why do you think that's differentiating? And maybe also you can touch on the fact that I heard you describe yourself as an early stage venture capital.
Yes.
Assumption is there is going to be also a late stage. Maybe describe to us the differences there, and then let's speak into the founders themselves.
Okay, great. So we'll start on that. So what Staircase Ventures does is we lead seed stage rounds into business-to-business software companies. Mm-hmm. So to be a bit more specific on that, our average initial investment will be about $1.5 million for about 10 to 15% of the company. Mm-hmm. Mm-hmm. So that gives you a sense. Typically, they'll be raising, $2 to $3 million. As I said, we would lead the round, and then we would, we would set the terms of the round, and then other investors typically come around the round. Sometimes we have done an entire financing, but typically there's other investors, maybe angel investors, maybe smaller funds who come in and fill out the round, and then we invest. And then typically that money is used for the company to get to the next stage, which could be on average, it's about 24 or 30 months later. Mm-hmm. And they would go and raise another round. And presumably, if everything goes well, they will raise at a higher valuation and they'll raise more money. And that propels them to the next stage of growth. In terms of the level of support, in terms of, hey, how do venture capital, what do venture capital firms do? Is they, as I said, their overall objective is to help the company be successful. Now, and then this feeds into the founders. So I have spent about a decade investing in early stage tech companies. And what I have found is virtually every venture capital firm will say, hey, yeah, we help our companies grow. And what do? Well, we do things to help the business grow, right? We'll introduce them to customers. We introduce them to engineers or other talent that they may want to hire. Sometimes we have analysts who will do financial analysis on the business and give insights to the founders, all those sorts of things. But I guess my perspective, and this is where the unique perspective of Staircase comes in, is if you talk, what I have observed, and frankly, what is generally agreed to in the sort of ecosystem, is that the founders are the most important success criteria. Mm-hmm. Because the track record of a young company, substituting out the founder CEO for another professional CEO, that track record is very poor, particularly in the early 5 or 6 years. Most successful tech companies are led by the founder as a CEO for several years, right? And I mean, even if you take the best examples, Amazon, Microsoft, Google, Facebook, all of those were founder-led for many, many years. Yeah. So then you say, okay, if the founder is the most important success criteria, why is it that investors are focusing on the business rather than on growing the founder? And so,
very good point.
Yeah. And the founder's role, having been a founder myself, it's extremely challenging, right? You are literally changing your role every 6 months as the company evolves and grows. And so I said, hey, I'm going to focus on that founder development and helping founders succeed. We're going to do all the business stuff that other folks talk about, but we're going to have unparalleled focus on founder growth. Mm-hmm. And the way I think about that is in 2 major areas. One is, how can we help our founders develop the skills that they need in order to continually upgrade their abilities to manage in the environment in which they manage and to manage a larger and larger team and more complex organization. And so for that, we do a couple of things. First of all, we have an amazing group of 8 advisors, all of whom have launched and built billion-dollar businesses. They get very involved in terms of providing both the business as well as the founder development advice. The other thing that we do is we provide coaching. So we don't provide it, we pay for, I should say, we pay for executive coaching for the CEOs, where we have a network of folks who are, this is what they do, is they specialize in helping and coaching CEO founders to adapt to the role, to develop their skills. The second thing that we do is all founders are entitled to join founder support groups. So this is a network of over that we've paid for our founders to join a network of over 2,000 founders across North America that they can join. So it's almost like a YPO type of model where they can learn and network. So that's really about founder growth. But then I think the other half of that is, you know, you need your founders to develop the skills, but you also need them to show up at their best every day. So the next part of the question was, okay, how can we help founders be in a position to be their best every day? And so on that, we do several things. So for instance, we have done a partnership with Cleveland Clinic Canada, whereby every founder has access to a health coach from Cleveland Clinic that can provide them with any sort of mental or physical health coaching, whether it be, you know, I'm not sleeping because I'm so stressed, or I'm working too many hours, or I need to lose, I don't feel very good because I haven't found time to go to the gym, or I'm not eating properly, like any sort of, as I said, health. So we have that. We have a financial advisor. And so all founders have access to a financial advisor who is specifically trained in founders and the needs for them. And so this is what I saw too many times, is founders get to an exit and they realize only at that point that they're not set up properly for their own tax planning, for their estate planning, etc. So we work with founders from the beginning, as well as things like, okay, you know, making sure that they're taking care of their own financial situation. And then the final thing is a family stipend. So this is a cash payment that we give to the founders in the first year that they can use unrestricted. And it's basically saying, hey, here's some cash that you can use, whether it's be for childcare or elder care, or, you know, take your significant other out for dinner every month because you don't see them enough because you're working so hard. Whatever it is, it's all about, hey, we recognize that people are whole people, that they have an entire life that they're trying to balance. And by taking care of those founders, they're in the best position to give their best to the company.
This is fantastic. I think that, so this, I think, breaks the stereotype that I had in my head, which is venture capitalists come, they give you some money, they take equity, and they provide you with some advice on the side and ask, when am I going to see my money? What you've really described is a whole system of support, which I love it. So you're treating your founder like an athlete, right?
Yeah. Yeah, and it's funny. Yeah, exactly. Well, it's funny. Yeah, exactly. Because I have an athletic background. And so it's like, yeah, you want, you know, if you're a coach for an Olympian, right? If you have, you know, if you're a coach, you think about the athlete, not just their training, but you're like, okay, hey, are you resting properly? Are you eating properly? Like, how can I help you perform the best on the day? But you're right. Like, when I first was asked to join a venture capital firm, my first reaction was, why would I do that? Aren't all VCs like nasty people who like are always banging on the table and asking more from the entrepreneur? And then what I did was I realized is actually the most successful venture capital folks form deep trusted relationships with their founders so that they can be a trusted resource and they care deeply about the founders and the founders' success.
Yeah. So what I heard you describe is the network of support that includes business advisors who can broker connections to the right people that perhaps should be hired to help the company grow. Then coaching support, then life balance support, health support through the clinic you mentioned, financial and tax setup and support. That whole package. Now, Janet, you are, of course, personally involved. How many organizations, how many startup companies can can a person like you, a partner in a firm like yours, how many of those companies can you actually support at the same time?
So it depends on the level of support. What I have found is once you make an investment, again, typically, and again, this is for a seed stage, but I think it applies for other stages, is the first year, and particularly the first 6 months, is heavy lifting time.
Yeah.
In terms of, and again, there's exceptions for everything, right? But generally speaking, it's the first 6 months to a year, because we're getting in at the early stage. And it's like, hey, helping the companies, they might need to hire 1 or 2 key executives. They may need to set up new processes, better understand their data. Often they're making key strategic decisions. And so there's a heavy lift. And frankly, I'm, new to the business, understanding their customers, understanding their industry, right? And we're getting to know each other. So that really is the heavy lifting part. And then after that, again, it depends. I've worked with some entrepreneurs who are serial successful entrepreneurs, and they, need less time than somebody, who may be a first-time entrepreneur. It also ebbs and flows. When a company is doing a round of financing, often there's a lot more time involved because the companies are, hey, helping them raise the money, introducing them to other investors, etc. But yeah, go ahead.
In the stage from like, I just had a bright idea and I think there is something behind it. Like I want to start my own business in tech, to the point of talking with you and having a discussion about you potentially investing in my company that is not a growing concern yet. At which point, like, how do people get to you? At which point do you actually entertain conversation with entrepreneurs, given that you are focused on early investment?
Yeah, so I would say, in terms of, just to give some sort of meat to the bone in terms of where we invest, and then I'll answer your question. So typically where we're investing is where the company has a product in market, initial indications of product market fit, and path that we can see how the business will be profitable and how they can acquire customers at a reasonable cost relative to their profit per customer. Yeah. That's where we invest. Now, then you say, okay, how long does it take for a company to get from idea to where it's a target Staircase Ventures investor? I would say, it can range, but on average, it's typically about 2 years. So then the next question is, hey, how do they get financed for those 2 years? It's typically, they start off with angels, friends and family, really bootstrapping it. Then they have, some pre-seed funds sort of go along. But your question in terms of how early do I meet with them, I think it depends. The reality is I can't meet with everybody at the very earliest stage, but at the same time, ideally, I will establish a relationship with the founders before it, so that I'm not seeing them for the first time when it's like, hey, they're pitching to me. Now, that happens a lot. It's okay, but it's great if I can establish a relationship over multiple years.
Earlier, yeah. This is actually very good. This actually explains exactly, to me at least, how this flows. A couple of questions that are coming from the audience that might be interested. Do you have any reflections on how would you prefer to, like, how many founders is the best number of founders within a tech company?
Yeah.
Do you have an experience on that front?
So absolutely. So I would say, first of all, there's no best, right? It varies. I've seen anything from 1 to 4 is what I've seen. Most often 2 to 2 is the most common.
Most common.
With 2, you have typically, again, there's exceptions, but typically you have 1 person is much more technical focused.
Yep.
And 1 person who's the CEO, who's out talking to customers, raising money. That's sort of the generic 2-person founding team.
Yeah.
I have seen solo founders, and I think the challenge with solo founders is it takes a whole range of skill sets in order to launch and build a company. And again, generally speaking, the founders of the company are more committed than anybody else. So therefore, by having multiple founders, you could have multiple people who are all in on the company. that being said, again, so 2 is often a good number. 3 can be good too. But when you get up to, like, I have backed successful companies that have 4 co-founders. It worked out that way. It worked out because it was very clear sort of who was running the ship, and the CEO, was making decisions. And then, sort of the who was doing what was very clear.
Yeah.
Where you get into problems when you have, I mean, it can happen with 2 founders, but particularly when if you get 3 or 4, there's a lot of almost cooks in the kitchen. And if you have 4 founders and all 4 that believe that they should have an equal say in every major decision, that can become a bit unwieldy.
Yeah, I can see that. So what I heard you effectively say, that oftentimes 2 is the right kind of, is the most frequent success story. One is more technical, the other one is more business.
Yes.
In our business. A
Yes.
couple of more questions that came through. Is there other circumstances where there are multiple venture capitalist firms investing in a same organization early, or is it typically not the case?
Absolutely, it can happen. And it could happen for a couple of different reasons. Like sometimes there'll be what like a pre-seed investor will go in and early on, and then a seed investor. Actually, let me just back up and say, typically there is a lead of a fund, of a round, right? And the leader of the round sets the terms. So they go in and they say, hey, here's the valuation, here's the terms. And then they set all those terms. Then other money comes in at the same terms that the lead investor leads. The lead investor typically is the one who does all the due diligence and sits on the board. And the other investors who are coming in with that lead are really relying on the lead to do the due diligence and to represent them on the board. Sometimes when you have one lead investor, occasionally you'll have other investors come in who are venture capital firms who will invest a small amount by saying, hey, you know what, we'll just invest a small amount and maybe we'll invest more at a subsequent amount. Then the other scenario is you can have a co-lead where 2 firms say, hey, you know what, let's co-lead. Let's each, as an example, put in $1 million and we'll actually co-lead. And maybe both firms will sit on the board. So that happens as well.
Right. Obviously, you mentioned this is higher risk than what banks would be typically comfortable with. How, and you mentioned also that you are sort of sitting on the board, that you provide introductions. What other mechanisms of risk management and controls do VCs typically have to ensure success? Because success is joint success, right?
Yes. So I would say, I mean, one thing is we typically virtually always invest in preferred shares. So, I mean, and so you have preferred rights. Beyond that, and then there's typically, documents written, there are documents, the documents often provide for veto rights, either at the board level or at an investor level, for instance, in terms of, taking on additional debt, issuing more shares. Typically the lead VC investor can block those sorts of things. So there are, and the lead VC needs to approve the budget. So there's things like that. Depending upon the structure, they could have more or less approval. But all that being said, I would say, in essence, in terms of the day-to-day running of the company, typically at the early stage, we do not control the company. It's the CEO and the founders who have majority control. And therefore, it's one reason why, I think about it, we don't have control. What we do is have influence. And when you have influence, you can only influence a person or a company if they trust you, both trust you that you are looking out for their interests, the company interests, that they trust you in terms of, hey, I trust you. They trust your judgment and they trust your intentions. And I think that is why, going back to sort of what we talked about earlier, the most successful venture investors start with a strong foundation of mutual trust and respect in the founders, because as a venture investor, you really, you do have some control on sort of the heavy hammer, but on a day-to-day basis, hey, how are you going to hire this person? Are you going to go into this market, the strategic choice, like all of that? It's really got to be done through influence. And so getting to know the founders and that development of the founders, so the founders can actually be the best leaders they can be, is extremely important.
Yeah, and it makes complete sense, especially when you mentioned that your typical investment is 10 to 15% of equity ownership. So
Yeah.
obviously the majority is with the founder. We had a couple of comments on that topic too. Is do you have circumstances where even early venture capital investment actually gets more than 50% of ownership, or is it rare?
I'd say it's very rare.
Very rare. Yeah.
Very rare. And the reason, I mean, there's a few reasons, but typically typically a company will raise multiple rounds.
Yeah.
Follow-on investors like to know that the founders have enough skin in the game and have enough ownership.
Yeah.
So if the founders have less than 50% from day one, then like after 3 or 4 more rounds, in each round, they typically get diluted on average 20 to 25%. They're not going to have a lot of ownership. And what I have seen is often follow-on investors will not come in if the founders don't have enough equity. Now they can recapitalize the company and issue more equity for the founders, but that gets messy, and then the existing investors don't like that. I mean, again, it happens, but it's rare.
Yeah. This is actually very, very insightful. I think that many people actually do not get to see this on the inside unless they themselves are founders and entrepreneurs, right? So this is really lighting up many bulbs in my head. I wanted to also have a bit of a conversation about how do we, as technology leaders who are buyers of tech services in the country, I'm talking specifically CIOs, CTOs, CDOs of governments and large companies, what is the role that we could and should play to help Canadians' tech ecosystem grow and expand? Like, what are we doing well? What should we be doing better? What role should governments have? What role should large institutions have? Let's talk a little bit about that.
Yeah, great. So I'll actually start with large organizations.
Yeah.
So I think the large organizations, ultimately, they are profit machines, and they owe their fiduciary duty to their shareholders. And you could say to their employees, and their customers. But in addition, maybe I believe that large Canadian corporations should be doing far more with this startup ecosystem, but not because, hey, they should do it because it's the duty and it's the right thing to do. I think that they should do it because it will help them as a corporation. It will help them to innovate. And so, and I'll be a little bit more specific. First of all, Canadian corporations generally, again, I'm making a huge assumption. It's not universal, but just generally, Canadian enterprises are less likely to adopt new technologies and to work with startups than their American counterparts. Company after company that I have worked with and that I have talked to says, what, we tried to sell in Canada. It was, they took a first meeting, they took a second meeting, nothing happened. They went on and on and on. I went to the US after first meeting, and before I knew it, I had a sale and I was working with them. So, and as I said, I come back to when I say, hey, US or Canadian companies should be doing more with startups. This is not a charity project. This is, hey, if Canadian companies want to stay at the forefront and compete and win against their American competitors, they need to be using technology, incorporating technology, and working with and using startups, like using the classic build, buy, or partner with other people, as they think about their technology options. And, partnering is one of the avenues that I think all Canadian companies should be thinking about.
So risk adverse in large organizations we are, eh?
Yeah.
Yes. Actually, also, that's another, I think, common known thing that, Canadian companies should leverage more of the Canadian startups. And I love that you said this is not charity, because people could view this as charity. Let me go and buy something that is local. But what you're saying now, that's fine, but that's not the right driver. The right driver is
that's not the role of Canadian corporations.
That's right. That's right. So the question is, the impetus should be, let me tap into this brilliant innovation group that's scattered across the country, and let me take this on as a customer number one, because I'll buy innovation through this. I'll buy a competitive advantage through it.
Yeah, and frankly, they don't even need to be customer number one. If they're like, hey, I like customer number one, that is sort of risky, right? But like, at least try be customer number two, customer number three, or whatever it is, right? But experiment and learn, and try.
Now, I know, of course, we work with CIOs every day, full day. These are busy people, and they get bombarded with emails, hundreds of a day. And everybody has a filter that filters them right into the junk and trash. Is there any advice to tech leaders on how do they actually get involved? How do they get informed? Where do they go to tap into these early tech startups to actually engage with them and learn?
Yeah. So, I mean, first of all, I would say, I don't know if it's like, I think the first question that the CIO would have is, hey, what role do they, does he or she personally want to have versus their corporation, right? And like,
that's such a good point too. Yeah.
So
that's a very good point. Yeah.
That's, I think, the first question, because a CIO has a huge amount of job responsibilities. They can't be the person who's most plugged into the startup ecosystem in their company, right? Yeah, if they want to get exposed, there's lots of different conferences or events, things that they can read. But I think starting at the beginning, I think what the company needs to say, and the CIO needs to say is, okay, what is going to be our strategy? And I'll lay out 3 different models that I have seen.
Mm-hmm.
And companies can use multiple versions, or can use more than one. One is, frankly, I would also say a lot of this has to be driven by the CEO. CIO can be a champion, but a lot of it has to come from the CEO as well. What we see is if the CEO is not on board and not pushing this agenda, it's very difficult to have meaningful progress. But the first way is to have the business units take ownership. Mm-hmm. And this typically takes the role of where the CEO or other leader in the company says, hey, okay, every business unit, you've got to be doing more technology, or, you've got to be more innovative. Again, by the way, I will say technology is a means to an end, not an end in itself. So it's not about, hey, you got to use more technology. It's like, you need to innovate faster. I want you to understand how to better meet your customer needs, or I want you to understand how you can reduce costs, or whatever the objective is, by using technology, because we know technology has the power to do those things. So it could be down on the business unit, and then the business unit is responsible for taking the steps, and different business units across the organization. It could be, the other thing that I've seen is more of what I call a clearinghouse, where an organization basically says, hey, we're going to have 2 or 3 people, and they're going to be, in their innovation hub or innovation group. And their role is to basically be the liaison between the business units and the tech community. So they are somebody who can say, okay, business units, you may or may not have those skills that are required to really go out to understand the technology landscape, to speak their language. So this business unit, the innovation unit, sits in the middle and says, okay, I'm going to go and talk to the business units. I understand their objectives. I understand their roadmap. And then I'm going to go out and I'm going to talk to some startups. And when I meet a startup or a tech company that I think is a good match, then then that innovation unit facilitates that introduction, and often is almost like a translator, right, to go in between and helps both parties work together. Mm-hmm, mm-hmm, so that's the second version, iteration. And the third that we see companies doing is basically setting up a venture studio, right, i.e. doing investing. And that can come in the form of, some companies are actually actively investing in companies or actively investing in funds. And we're seeing several banks and other companies investing in funds, and then those funds give, with sort of one investment, they get access to their whole portfolio. Yeah. For instance, Staircase, we've been fortunate enough to get investment from our Royal Bank of Canada and from Intact Insurance. And so, we work with them that way to be able to sit down every quarter and say, hey, not only here are our investments, but here's what we're seeing in the market. What are you looking for? Oh, you're looking for this type of company. Great. we see hundreds and hundreds of companies every quarter. Let's see if we can facilitate an introduction.
Yeah. And that third one is actually quite real for me. We as a firm, Deloitte has actually established Deloitte Ventures for exactly that purpose, to be able to co-invest in Canadian tech startups that are obviously aligned to our business. We all know, of course, the existence of incubators and accelerators that exist across the country. Any comments on how firms like yours, venture capital firms, coexist, collaborate, cooperate? Do you compete with accelerators? How does that relationship work?
Yeah, no, we work very collaboratively with them. So I was on the board of Communitech for many years, on the Vector for many years. Our office actually pre-COVID was located in Mars. So we are very involved, and we really view us as partnerships. What the accelerators do is they provide services to young companies, and they often have somebody within the accelerator whose role is to be the liaison between the startups and the investors. And so we love the fact that we get to know them. They'll often have demo days. I volunteer my time to go and speak to the different accelerators, to talk to their founders about different topics, and be a bit of a mentor for them. So very much a collaborative. They do something very important, and we play a different role, typically getting involved a little bit later than the accelerators.
Yeah. We also got a question about the government and the role that government is playing in supporting an ecosystem. Are you able to comment a little bit on that? What is the role? Is there a opportunity to do this better or differently for common good?
Yeah, it's a good question. You may be familiar with the VCCI program, which was the next iteration of the VCAP. So there was something called VCAP, and then they came out with what the short form is VICI, but it's VCCI. They've come out with a couple of VCCI programs, and what those programs do is the federal government gives. I shouldn't say gives, but it invests in fund of fund managers in exchange for them having to go out and raise more money. So it's a way to amplify every dollar that every dollar that the federal government puts into fund of funds, they need to go out and raise up to $3 additional. And the federal government money it's the first in and the last out. So it makes it easier for these funds of funds to go and raise money. So that's a program. It's been running for several years. The CVCA, the Canadian Venture Capital Association, has done a lot of work showing that actually the money comes back to the government makes a very strong return on the money, and it does a good job of amplifying their impact. So that's one program. As I said, we're currently in the third iteration of that program, and I think it has been very successful. Then, there's other different provinces play different roles as well.
So in other words, there are active programs at federal level, at provincial level that are available. And
yes, both just funds as well as to in many cases to companies specifically.
Okay. Yeah. Excellent. I got one question which is kind of cute, but I wanted to ask you, how many pitches do you get weekly, or how many pitches does a venture capitalist partner should expect to be hearing weekly?
So weekly. So let me see. I see a few hundred every quarter, over 1,000 a year. Now,
over 1,000. Yeah.
That's in a year.
Yeah.
Mind you, that counts everything, right? That doesn't mean I meet with 1,000. That's how many cross my radar screen in a year. It includes, I'll go to an event, to go to a pitch day, maybe at Communitech, and see 20 companies present. Right? So that includes companies that come into my inbox and I say, no, thank you. It's not a great fit. So it includes a lot. I think, so yeah, you see a lot. You don't take as many meetings, obviously. I think relative to a lot of VCs, I have very strong deals, like in terms of the number of companies I see. I really appreciate having a lot of deal flow because, well, yes, it's time consuming and it means you work long hours and all that good stuff. I think it's extremely effective because I'm now at the point, having done this for 10 years, where I see things and I think, okay, yeah, I've seen that idea 4 times over the last, 6 years.
Yeah.
In every case, it didn't end up working. So like this company better have something like a different take on it in order to be effective.
Mm-hmm. So what is the most effective way to actually get to present to you, Janet?
Well, I will say we read every email that comes through. I think one of the pillars of Staircase Ventures and one of our values is that, or let me just say, I think the VC world for too long has been, it's all about who you know influences the access you get.
Yeah.
And I don't think that that's right. And so our policy is any single email that comes in, whether it comes into our inbox or comes into me directly, gets looked at. So, anything or email.
So it could be as simple as contacting you and saying, here is my idea. This is where I'm at.
Here's my pitch deck.
Yeah.
Or here's my idea, and you will get a response.
That's very good. That's very good. So Janet, we are coming to the last few minutes. Call for action. I would love for you to, like, if for a listener who has an idea about starting a tech company, what would be the right call for action? What is a call for action to our executives on the call who are thinking on how do I better engage with this ecosystem? What would you advise both of these stakeholder groups?
I would just say, like, I know it's like, just jump in. You don't need to know. And I think about my own life, right? When I have done things, whether it be launch Kijiji, go into venture capital, start my own fund. Like, I didn't know every step of the road, but I knew where I wanted to go, and I knew how to get to I knew what the next step should be, and I knew I would figure it out along the way. Yep. So, like, jump in, believe in yourself, go for it, and surround yourself with people who you can learn from and who inspire you.
That's fantastic. And what would be the call for action to the buyers of the tech services?
Again, jump in, start meeting with people. Think about yes, there's always going to be risk, but it's also, if you're an early customer, maybe it's not going to work out, but also think about the upside, right? You can't just look at think about the upside as well, and the opportunity cost of not trying something new.
Yeah. This was fantastic. This was so educational, and thank you so very much, Janet, for your time. I know we all, I see your hearts flowing and thumbs up and so forth. So I know that the audience is appreciating. Obviously, we have recorded this session. We're going to send a link to everyone who registered so they can review it at their leisure, of course. Staircase Ventures is the firm. Of course, you are on LinkedIn, and people can reach out to you and connect with you. And for our audience members, our next live webcasts, which are going to happen 2 weeks from now, October the 11th, we are going to talk about a very important topic around tech leadership. We're going to talk about the power of storytelling for technology leaders. We know that our organizations expect us to show up at that table as business executives. And we have this important capability of how do we actually tell a compelling story that oftentimes is a missed art. So we're going to be joined by Nick Kindler from Kindler Associate, and his whole business really is focused on helping business executives, but also academia create compelling stories. Nick has been training TED Talk speakers and Singularity University faculty on how to deliver their world-changing speeches. So I hope you will join us on October the 11th. Janet, with that, I want to thank you very much again. It was a real pleasure.
Thank you very much for having me. Great to be here.
Absolutely lovely. And everybody else, have a lovely Wednesday. See you in a couple of weeks. Bye-bye.
Bye.